Here are our profitability ratios that more relate to the income statement. Again, I personally would memorize these. It's not going to be, you're not going to possibly fail if you don't, but just make your life easier. Do the work ahead of time, memorize them here. And let's see another example. Well, we have Spear Company or Spear Corporation had sales of $2 million, a profit margin of 11. Okay, I always get distracted. Let me read the question. After the refinancing, what is Spear's return on equity? All right, interesting. So we see here in this question, similar to what I was mentioning before, we have a change in our equity structure and our financing structure. How does that affect particular formulas such as the return on equity? Well, first, let's calculate we have to calculate our normal return on equity. And then what is it afterward? We have our return on equity is net income divided by equity. So the return on equity before we refinanced and we decided to reduce the debt ratio by selling new common stock and using the proceeds to repay principal on some outstanding long-term debt. Right? We have pros and cons to having debt and pros and cons to having equity, common stock, selling all parts of your company, that's your ownership and your profits. Debt is just got that locked in interest rate. Again, just pros and cons. Why is the company doing this? Well, they want to reduce their debt ratio. Not really important to us, but make sure you memorize the debt ratio as well. What are we going to do here? We're going to say current profit is the profit margin times the sales. That gives us $220,000. And its return on equity before the refinancing is equal to 17.6%. That comes from our profit margin divided by our net income divided by our equity amount. And what do we see? Well, the debt ratio is debt divided by equity. We see it's now 50, so 0.5. It's 50% debt, 50% equity. How did we get this here? Very interesting question, actually, a pretty fun question. Well, our accounting equation, assets equals liabilities plus equity. Now, if assets are $2,500,000, liabilities plus equity would also have to be $2,500,000. Now, if the ratio of debt to equity is 0.5, that would mean that $1,250,000 is debt, and that amount is also equity. That is how we're going to get 17.6 as our, again, beginning pre-refinancing return on equity. Then return on equity after the refinancing is going to be that same amount, the current profit, divided by our change. Now, what do we change here? We reduced the debt ratio to 0.4 from 0.5 by selling new common stock. Debt divided by equity. Equity now consists of 60%, and that's 60% of the $2,500,000. That's going to give us 14.7%. Very interesting question, right? We want to see the understanding what happens when we issue new common stock, when we maybe issue new debt. What's the impact, and did the creators of the financial statement, did management account for this properly and accrue for it? More profitability ratios, just going to see these here. Return on sales, return on investment, return on assets, definitely important ones to have memorized. Not going to get into these too much, but really just how effectively are you running your company? How effectively are you managing your assets? You want to have higher net income for lower assets, meaning you're utilizing your assets very well. You're making more money with less assets. You're making more money with less equity. You're doing more with less of what you have. Return on investment, you're making more money with less investment, initial investment or continued investment. Same situation all around. Here is another great example of using our profitability ratios. Well, this is our growth rate. What is the expected growth rate? Just kind of plug in our amounts that we have. We maintain a return on assets of 8.5 in year one, as well as ensuring a policy of paying out 35% of all earnings as dividends. What is our expected growth rate? Well, our retention is kind of saying what's our retention of cash, and retaining that is our dividends. So you see this here, 35% of all earnings as dividends. We're retaining that for the shareholders. We're going to take our return on assets, which is 8.5%, times our 35%, and divide that by 1 minus both of those, giving us a growth rate of 3.07. This is saying how much is the company growing? The company's growing 3.07% per year. You could compare this to the industry average, compare this to competitors. Diving in further, we've got this profitability ratio example. We are going to need to calculate the return on investment as of 12/31 year 2 since inception. Presumably we began operations here. Year one, we get the following information. Well, return on investment, step one, just write out that formula. We see that formula there being net income divided by average invested capital. And think about it. Do you want that higher or lower? In this case, I would say we want that higher. We want higher net income for investing less money. I mean, think about it for yourself. Would you want to make more money having put up less of your money up front? I would say so. I think that's great. Compare that to the industry average, compare that to prior years. Is their ROI going up, going down? Let's see what net income is going to be. Net income for year one, that's going to be sales minus variable and fixed costs. And then year two is going to be 300,000 of sales minus, again, variable and fixed costs. Here we want the net income for the whole period. So as of this date since inception. So we want for the full 2 years, meaning we want the full 2 years worth of net income, which is why we're adding up all the amounts, getting $150,000 of net income the first 2 years. Then average invested capital for the first 2 years, 30,000 plus 50,000 divided by 2 gives us 40. 150,000 divided by 40,000 gives us 3.75. Very good, very good. Moving along and having a good time. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.